Welcome back, guys. Today we are going over 3 amazing dividend stocks that pay out monthly. I love monthly dividend stocks. They are on the top of my list right now. These 3 are my current favorite. Now, sometimes that shifts, but right now, as of right now, I'm looking at these 3, doing more research and purchasing some of them. There's one that I haven't purchased yet, but I am planning on it, waiting for the right time in the market. And the others, some I've owned for a while, some are newer to me. We're going to get into all of that. But as dividend investors, our goal is always to replace our income with dividend yielding stocks. Maybe not now if you're younger, you're just waiting, trying to build up your dividend portfolio. That's what I'm currently doing. I reinvest all my dividends because I think it's amazing to do. And maybe you're not, maybe you're living off these dividends, but either way, we're going to get into these stocks that pay a good, consistent dividend yield. We don't want cuts. We don't want high payout ratios, and we're going to go over all of that. And while I do love these high yielding stocks, I actually have been focusing a little bit on growth as well. That being said, when you can combine growth and dividends, it is the perfect mix. So we'll talk about that a little bit. Some of these have higher growth, some of these have lower growth, some of these are a little more speculative, but overall, I think these are all solid picks. It's not financial advice, but I want to know what you guys think. So leave a comment down below and like the video if you found it useful. That helps me and lets me know what you guys like, and let's jump straight into it. So our first insane monthly paying dividend stock is Realty Income, probably the king of REITs, the king of monthly income, a phenomenal stock. And we're going to talk all about it, but I want you guys to know that all this information I'm grabbing from the investor presentations and some of the financial data from seekingalpha.com. Now, the investor presentations are all up on their website. Go check them out. If you ever want to research a company, I really suggest going through these. It can be super beneficial to learning more about the company, and Realty Income has some phenomenal ones. So we can see right off the bat, Realty Income is beaten down. It's definitely on sale, currently down 19% in the last year alone. Now, a lot of REITs have been beaten up because of interest rates going up. And for those of you that don't understand how those two coincide, well, when interest rates are up, these REITs have a lot of outstanding debt for the properties they own, and thus they're paying more money for the debt that they're holding. Now, the market cap is huge at almost $46 billion, and the dividend yield is 5.6%, which is phenomenal. Now, if we jump to the 5-year chart, they've been trading a little bit down still on the 5-year, but the all-time chart shows they're up 560% all-time, which is a beautiful thing, maintaining the dividend payouts, maintaining acquisitions, and continuing to do just extremely well in the REIT business. Now, their payout ratio is pretty low at 74%, which I like. I like to keep it under 80 for safety reasons, and the 26 years of consecutive dividends with dividend growth have been phenomenal. Realty Income is the global leader in fragmented net lease sector, which is great news. You can see the global side of things growing, which is great. They're growing international presence, but there's a lot to unpack with this slide from their presentation. $56 billion in enterprise value and $3.9 billion in annualized base rent. That is actually insane. They're making $4 billion a year from rent. 54 years of operating history, which you love to see, and they have 13,282 properties. A huge number of properties. When you're looking at other REITs like ADC, they're significantly less properties, which is more work, but again, more profitability if they are doing their job correctly. So they have some really good information. Here you can see how many clients they have. They're 85 industries, and that 91% of their rent, this is what they say. They say 91% of their total rent is resilient to economic downturns and or isolated from e-commerce pressure, which is a very important thing to note. Now, they keep talking about their dividend track record. They're going to bring that up a number of times with 29 consecutive years of rising dividends, 4.3% compound annual growth rate, and that's annualized since the beginning of them paying out those dividends. 640 monthly dividends declared, 104 consecutive quarterly increases. That's an insane amount. And they are a member of the Dividend Aristocrats, the S&P 500 fund, which I might talk about because that's actually extremely interesting to me. Looking at the industry side of things, they have 38 industries. I will talk a little bit more about all the different industries they're in and their main property holders when we go over their portfolio, but they do have a $10 billion $9 billion European portfolio, and they're the 7th largest global REIT. So some really good, interesting information to know if you're looking at purchasing Realty Income. One of the number one questions I get from new investors who are looking to purchase dividend yielding stocks is what is strong but safe? What is a insanely good dividend stock with a high yield that will make me a lot of money and has an extremely low chance of costing me money in the long run? When people start purchasing things like the Yield Max ETFs or even some of the covered call ETFs like QYLD, RYLD, even JEPI, sometimes they have a bad track record, especially the Yield Max funds, which I will talk about later on in another video if you guys are interested. But Realty Income just comes to the forefront of my mind every single time because of the size of its market cap, the amazing job that the company has been doing, that their team has been doing when it comes to purchasing properties and maintaining everything. It's just outstanding. So looking at their track record, I just want to show almost everybody this slide because it's one of the most important ones, I think. They have a 13.4% compound annual total return since they were listed on the New York Stock Exchange in 1994. I wasn't even born yet. 26 of 27 years of positive earnings per share growth. They have been killing it. And another thing to note is they've never cut their dividend. So even when they had a year of negative earnings per share, they still maintained their dividend, which is amazing. 4.3 compound annual growth rate. Like I said earlier, that is just outstanding. I mean, the bigger this company gets, it's going to be hard to maintain that, but they have been killing the game with their growth. And I love these growth and dividends combined into one company, into one stock. You don't have to go risking it. If the market tanks to lose a bunch of value, you still get those dividends, and vice versa. When the stock market is booming and the economy is doing well, you get the price appreciation and the dividends continue to roll in. So it's really, this slide is probably my favorite out of the entire presentation. Plus they have 12 trillion estimated global net lease addressable market, which is great. That is more on the expansion side of things. There is more that they can do to grow, and 95 billion sourced acquisition opportunities in 2022. So a lot of growth potential. This company, a lot of people say that this company is done for, as in it's not going to continue to grow. It's not going to be a good one. It's just going to pay out dividends, but they are looking to the future. And that is, I think, extremely important, especially if you are a younger investor. Looking more into their growth and their dividend yield, we can see another slide from the presentation shows how if you have their dividend from 4 to 5%, which it's even above 5% currently, and you have the AFFO per share growth of 4 to 5%, you're averaging a return of 8 to 10%, which this is extremely, extremely important to know, because if you're reinvesting dividends, you can capitalize on the share growth as well. Where if we're looking at a fund like JEPI or JEPQ, or even the Yield Max funds, if you're reinvesting those, the price depreciation over time is not good and it's hard to watch. So with Realty Income, you can be growing how many shares you have, growing that yield on top of that, and continuing to grow your capital in comparison to getting more and more dividends in a stock that is continuing to downtrend. So this is a really important slide as well. I know I've said that 100 times with every slide so far, but there's a lot of good information in their investor presentations. All right, let's talk portfolio. They're so diversified. I'm not going to say they're the most diversified because I could not make a claim like that, but they're extremely diversified, which I love to see. Starting with their industries. Grocery stores, 11.4%. Convenience stores, 10%. Dollar stores, 7%. Drug stores, 6%. Home improvement, 6%. Restaurants, quick service and casual dining, 5% for quick service, 4.5% for casual dining. So they have a lot of different industries that they are in, which is really nice. And remember when I talked about how they said that they are resistant to e-commerce and resistant to recession type of events, we kind of see that with where they're diversified. So let's see, grocery stores, e-commerce. I doubt you're going to have problems with e-commerce with grocery stores unless Amazon starts huge grocery stores and delivers groceries. But grocery stores, convenience stores, drug stores, dollar stores, all stuff that people will continue to go to, whether it's a recession, whether the economy is booming, people will continue to use these things. Home improvement, people are always going to need home projects. DIY stuff is booming right now. Restaurants, people will always eat out. Even if the economy goes down, people still find money to eat out, which I am not a huge fan of. I think it's a bit of a waste of money, but that's just my personal opinion. Now, looking at their high quality portfolio, as they call it, their top 20 clients, think of if you know these names: Walgreens, Dollar General, Dollar Tree, 7-Eleven, FedEx, LA Fitness, Lifetime Fitness, CVS Pharmacy, Walmart, Sam's Club, Tractor Supply, AMC Theaters, Regal Cinemas. There's so many different client types that are on this list, and I love how diversified they are. The highest percentage they have in one of these clients is not even 4%. So that diversification is extremely important. I think that they are doing a really good job with this. And geographically, look at this. They have a UK presence of 12.3% of their total portfolio. Texas is 10%, California 5%, Florida 5%, Illinois 5%, Massachusetts 4.5%, Ohio 4%. And just more diversification all over. I like that they are growing globally. I think that's really, really important because, of course, the U.S. has some benefits, but it's nice to be more of an economic powerhouse looking at the globalized version of these REITs, because you have a lot of just US-based REITs, and it's not necessarily a bad thing. It's probably a bit simpler, but if you have a really strong management team, like I think Realty Income does, having more access to different property types in different areas can be a huge bonus. Plus, property type diversification. They are 82, almost 83% retail, 13% industrial, and then really small percents of gaming and other. So not as diversified. They are heavy in the retail, but not in a bad way because of how diversified they are in the retail sector. One of the key metrics to judge a REIT by is its portfolio occupancy. This is how they make their money. A quick explanation of this term, portfolio occupancy, is the percentage of their properties that are filled with tenants currently. So it is extremely important because what you want is you don't want a lot of buildings that are sitting and deteriorating over time without making you money, where you're still paying money back on the debt and interest and all things of that sort. So Realty Income has the best portfolio occupancy that I've ever seen in a REIT, but I haven't looked deeply into a lot of REITs. I will admit that. But over time, we can see they have maintained this high 90s, like 97, I think is their lowest percentage that they've been at. And the sector median is like 92. So they really are a powerhouse in this area as well. And this is really all about safety for me, because if they are keeping their tenants happy and they have these long-term leases, it is extremely, extremely important. We do see a little bit of a dip in 2008, 2009 with all the crisis going on at that point within the stock market and the economy, but they immediately bumped it back up and have been killing it ever since. Jumping over to seekingalpha.com, we can see their dividend history, consecutive years of growth, 26 years, sector median 1 year. So their percent difference to the sector is huge, as well as their years of consecutive dividend payments, which is 26 years to the sector median of 8.14. So this just shows how long they've been paying out these dividends. They have been in the business for an extremely long time, and as you can see, no dividend cuts. You may see some dips here and there, but that is due to special dividends paying out prior and then it going back to the original what it was paying out. So they don't pay a ton of special dividends. I wish they paid more, but to be honest, what more can you ask for? They have growth, they have dividends, they have everything that you would need when looking at a REIT, so I can't complain too much. But I wanted to zoom this out and show you guys the exact dividend history. Here's another chart from their investor presentation. I wanted to show quickly their annualized dividends, and it shows their year-end dividend increases. So they have just been continuing to blow this dividend up. You love to see it. It's a reason why everyone loves Realty Income. I am quickly going to go over a few of the cons that I see with Realty Income, as well as some that the community have expressed. Now, of course, I am biased to Realty Income. I do own this one, of course. But one of the main things is lower growth rates, as we've seen the past couple of years with their compound annual growth rate being a little bit low. Now, the bigger it gets, the harder it's going to be to grow on a percentage basis, but it is still a good company that is focusing on growth. It's just not going to have the explosive growth that you would see from a smaller or newer REIT that is doing the same kind of things that Realty Income is. But you take the good with the bad with this kind of company because it's been performing so well and so consistently for so long that people rely on it for those things. They're not buying into this for it to triple in price over the next 5 years because it's extremely unlikely for that to happen. Now, another con, which we're going to see with all REITs, is that it is impacted by these interest rates. Now, with 2024 being a year the Fed was saying they were going to lower rates, that would be nice and it would overall help the REIT sector. But it's a bummer when you have to rely on things like interest rates because they do move around all the time and it's completely out of our control. And so that being said, those are kind of the only two cons. Now, a con and a bonus is that they are at a dip right now. I have added more, but that is just my personal opinion on what I'm doing. It's not financial advice. I do think there's a lot of hope for this company, and I love purchasing it, and I love the monthly dividends. But now we are going to move on to the next company, Main Street Capital. This company just puts a smile on my face. I'll say that right off the bat. I have not owned this for very long. I purchased it a couple months ago, and that's not financial advice. It's just what I've been doing. I put it in my Roth IRA because their growth and their dividend have been blowing me away. So starting off with some of the key points about this stock is the fact that the market cap just under $4 billion, some good room for growth, PE ratio of 9.24. So it's definitely considered undervalued PE ratio wise. Typically, you're ranging from 10 to 20% as a common value. So it is a little bit undervalued, and a dividend yield of 6.32%. Honestly, I don't think you can't get much better than that. These BDCs are a little bit higher risk, I would say, but Main Street has been doing phenomenally well, and their history shows nothing but consistent gains. So the beautiful thing with Main Street Capital, it's up 17% the last year. I'm green on this stock, of course. I purchased a few months ago, like I said, and it has been just so good for me so far. Now, when you bring on that 17% a year gain in just price appreciation, and you pair that with a near 7% yield, because the yield has come down a bit as the price appreciation goes up, because they are correlated, you are just matched with an insane amount of income, 25% on the year roughly, maybe a little bit under that, but it has just been doing extremely, extremely well, and I'm excited to see this grow in the long term. It is definitely becoming one of my favorites. I've been watching it pretty consistently for a few years now, and I never purchased it. I just never was a huge fan until I did a bunch of research into it, and I've been seeing how it's been performing, and boom, now I'm probably the number one fan. On top of last year, how well it's been performing, their max chart, it's up 203.6% all time since 2007. So some really consistent and strong returns, which not a lot of stocks can say they've done that, but Main Street Capital has. So Main is very, very different than Realty Income, as in REITs are very different than BDCs. So BDCs, business development corporations, they prop up lower to middle capital companies. So companies that don't have the money that they want to grow they can be purchased or sponsored, so to speak, by a BDC. They are investing in these companies to grow and then make a return on their investment. And whether the investment is a percentage of the company or whether it's just a loan that they're accruing interest on, a lot goes into these BDCs. So the main thing with BDCs is the management team, which we will talk about, but they have some explosive growth, as we see with Main Street Capital. So the monthly dividend has never been decreased, and it's grown by 118% since the IPO, which is just phenomenal. That's really strong growth. When you're looking at BDCs, I typically aim more for growth than dividends, but this is another company that does both, similar to Realty Income. So it is pretty phenomenal. Based on the current annualized monthly dividends declared for the first quarter of 2024, the annual effective yield on Main stock is a 7.3%, even higher than it currently is from the end of 2023. Again, phenomenal. Based on the current annualized total monthly dividends and supplemental dividends declared for the fourth quarter of 2023, the annual effective yield on Main stock is 10%. And it's also paid or declared supplemental dividends of $5.44 per share since their IPO. So some insane bonus dividends, which I love. They are one of my favorite things. I think Main Street is the best at special dividends, at least from what I've seen. They pay out a bunch of money in special dividends, and you really can't beat it. As we can see, from 2008, they were paying about $1.32, $1.33 a share. They now pay $2.75 a share. An insane amount of growth over the past just under 20 years, about 17 years of just growth, consistency, and the price appreciation over that time has also been phenomenal. Just like we looked at these key metrics for the REITs, we're going to talk about some of the key metrics for the BDC. And one of the main things is operating costs. As we can see from this chart, Main has an insane advantage with operating costs. And there is one very strong reason for this, is that they are what is called internally managed. So when it comes to internally managed BDCs, this means that this company is looking into smaller businesses, mid-level businesses on their own. They have a full team dedicated to doing this. So there are some pros and cons to being internally managed. One, it's more responsibility. It's more risk on your shoulders because your team is the one making the huge decisions for you. But the pros of this are you're not paying someone else to do it. So you are paying your own team to do it, but you're not paying an outside business to do it for you, which would be significantly more expensive. You can look at other BDCs that are externally managed, and it's not necessarily a bad thing. Some of them are really good. But when it comes to just having lower operating costs, being internally managed is a huge benefit. We can see right here that the operating expenses as a percentage of total assets is much lower than other BDCs, commercial banks, by a pretty significant margin, I would say. So it's something to consider when you're looking at BDCs and what you're looking at buying, because this can really stunt their growth if they're paying out a ton of money to other companies to get them these acquisitions and these investments when they could be just growing their own team that can do it phenomenally well over time. So it is a mixed bag of opinions. People really, I've heard it go both ways. People like both ways. It's not necessarily a reason why I wouldn't purchase a company as if they were externally managed, but all in all, there are pros and cons that weigh into your decisions. In similar fashion with REITs, price performance plays a big role into what I purchase in the stock market. We can see with Maine's total return performance since its IPO, it has destroyed. So here it is compared to the S&P 500, the Russell 2000 index. That's the small cap index, which is usually the most aggressive, and then regional bank index and the S&P BDC index. So the S&P BDC index has been performing terribly. This actually surprised me quite a bit. S&P, of course, is in second place, but still it's not even half of what Maine has been doing. So total, it's just been phenomenal. It had a recession period where it still grew, the pandemic where it dropped like mad and continued to grow after that. An insane period of growth was the post-pandemic or post-beginning pandemic period for Main Street Capital. And they've been continuing to grow since then. Now, I do get a little uneasy buying things near all-time highs, but when it comes to a company like Maine, I'm not sure if it's going to dip significantly enough where I would want to put a bunch of money into it with how it has been performing. Now, that being said, it definitely could. But when you look at the price history of this stock, it glows in my eyes as one of the best ones that you can look at. And I cannot believe I didn't buy it sooner. I could have purchased this when I first started investing in like 2018, and I would be much better off than I am now, but I didn't, and we can't go back. You can't go back no matter how much you want to, but this chart really speaks volumes to me. And so we will finish up our discussion of Main Street Capital with a couple things they wanted their investors to know. From their investor relations page is where I pulled all this information. We can see they have 195 cumulative investments, which is a good amount. They have paid out a total almost $40 per share in cumulative dividends. That is dividends from the beginning of their IPO that they paid out to the present, $40. Absolutely insane. And of course, their capital under management is $6.8 billion, a huge amount, much more than their market cap, about $4 billion more. So they have a lot of money for expanding. And of course, when it comes to BDCs, you need money to invest in these smaller and mid-cap companies. So that is a great thing in my eyes. So Maine has quickly become one of my favorite stocks. It's actually grown pretty steadily to be one of the largest in my portfolio. Of course, I am diversified, but I cannot get enough of this stock. I will continue to dollar cost average in, and if it dips, I will be considering buying a good amount depending on how the market is looking. But now on to our third and final stock, our monthly dividend stock of Gladstone Capital. All right, this video is taking me quite a while, but I'm trying to get through GLAD, a really phenomenal dividend stock. It's got a 9.14% dividend yield and just under a 500 million market cap. Now, the PE ratio is great at 9.5, and this is another BDC. So Gladstone has a number of these. GAIN is another BDC, and LAND, I believe, is a REIT by Gladstone that owns just parcels of land, which is an interesting one, but it has too low of a dividend, about 3.5% last time I checked. Now, we can see that over the past 5 years that Gladstone has been doing pretty well, that it's up almost 24%, about 23.5%. And then when we jump to the 5-year chart, we can see it is down 40% all time. That's why this one is more speculative, in my opinion. Gain's chart is a little bit similar, but honestly a little bit better. But I still think Glad is the front runner for me. Now, we're going to jump into the financials and look at their investor presentation. I'll be honest, the presentation did not wow me. It's hard when you're comparing this one to like really income, because theirs are always phenomenal and beautiful. They look like works of art, and Main Street Capitals are really well done too. So this one, it's not awful, but there could be some changes that would make it look a little bit better. But that's kind of a nitpicky thing, but let's jump into it. Starting off with some strong pros for Gladstone, they are very diversified. We can see they have a diversified conglomerate service, 20%, diversified conglomerate manufacturing, 22%, healthcare, education, childcare, 21%, aerospace and defense, my favorite at almost 14%. As the world is heading into more economic and geographic turmoil, I think that aerospace and defense could be phenomenal. Food, beverage, and tobacco, always a pretty solid one. Then they also have oil and gas, automotive, machinery, telecommunications, a lot. So when it comes to this other graph that we see, the deal source composition. So sponsor-backed loans is how they primarily get their loans. So what this means is they're getting loans from private equity firms. This is not a bank loan. So these loans, they're usually, I would say, a little bit more speculative, a little more higher risk for these equity firms, but they know what they're doing. You know, they're going to know significantly more about this and everything than I am, so it's not even my business to say if Glad is a good investment for them. But then you look at the non-sponsored at 20%, and they have a couple other small ones, Glad controlled, syndications, and affiliate sponsors. So yeah, primarily sponsor-backed loans, which isn't bad. It can be easier for them to get, let's say, financing for more complicated deals. From my research is what I found, that it's easier to get more money and it's not as complicated as it would be with the banks, but it is a little bit higher risk from what I could tell. So some interesting information right off the bat, but of course, because this is a bit higher risk with Glad and that higher dividend, it is there's potential for more profits than we would see with Maine or Realty Income. I'm going to try and go quick through the financial summary and just point out some of the main things about this company. So this is Q3 of 2023. Q4 hasn't come out yet, but they did have an interesting quarter. Some good, some bad. So their income did increase. Their expenses increased as well. And one of the main things was their net investment income, NII, did drop ever so slightly. But there is some bonus to that because the portfolio value also came down, but their debt reduced by $61,000. So a pretty good dip there in the debt, and that really affected the debt to equity ratio because their net asset value did go up quite a bit by about $60,000. So the debt to equity made a significant drop from 104% to 76%, which is a bit safer. So some good news, even if it was a bit of a slower quarter, they did some good things with the money, and it is reflecting that. Even though there's a little bit of drop in the portfolio at fair value, they made some good business decisions, I would say. Now taking a look at Glad, we see the real risk behind this stock with the dividend history. So like I said, I haven't purchased this one yet, but I am waiting to at least do a starter position. Their years of dividend growth, 2, which is below sector median, which we don't like to see, but consecutive years of dividend payments is at 20 years. So that one is above the sector median, but we do need to talk about some things. It has had 2 significant dividend cuts. We can see it does pay monthly, which of course this is a monthly dividend stock video, but they did cut their dividend late 2008, 2009 from 14 cents to 7 cents a share. So it was a significant drop of 50% in the dividend. Of course, with everything that was going on with financial sector at that time, I'm not surprised that there would be a dividend cut, but still not something you want to see. Now, on the other hand, there is a bit of a bright side as they were relatively consistent from that point on all the way up until 2020, 2021, where they cut their dividend again. This time they cut it from 7 cents to 6.5 cents and then quickly regrew it within about a 1 to 2 year period. So there have been periods of some pretty explosive growth, but they do have a history with some dividend cuts that I don't like to see. It does make it a higher risk investment, but when you have a 9% dividend yield, you have to realize that you will be taking on some risk. They also did pay a special dividend in 2023, which I believe would have recouped a good amount of those losses from the dividend cut anyway, but still you don't want to have speculation when you're looking at consistency. So if we're going to be rating these stocks total, I would say Realty Income is my personal favorite. It is the safest. Then I would put Main Street Capital in the middle has higher growth potential than Realty Income, but also higher risk. And then I would put Gladstone at the top. So Gladstone at the top when it comes to risk. So it's the riskiest. It has the most potential, I would say, to make you significant amounts of income, but it is not by any means a safe play. And so when you're looking at these stocks, you have to think about those things. Stay focused. Think about what you want in the long term. Think about what your investment goals are. And that will help you in making your choices on what stocks to buy. And as always, do a ton of research and figure out exactly what you are looking for and find out how to read these investor relation reports. All this kind of stuff is super imperative to a solid, well-rounded investor. Not even when it comes to dividend stocks, just overall. Do a bunch of research, let me know, and drop a comment and let me know what you guys think about this. Is this Are these the best dividend stocks that pay monthly? I want to know what your favorite is of the three, or your favorite overall, and let me know, and I will see you in the next video.